I'm Alfred Quinsay, the Strategic Realist. Let's talk about labor. Most managers see labor as an unavoidable cost of doing business, but a strategist sees the real secret to market dominance isn't cheap labor. It's no labor. It's the ability to decouple your work from the cost of human work. That is the definition of financial leverage. And it's the most ruthless, effective strategy in maximizing profit in a competitive market. Today, we're dissecting the core mechanisms of strategic success. Operate. We will learn how to turn high fixed costs like software, AI, and automation into the most powerful weapon in your arsenal. Stick around. But before we dive in, let's talk about the two most essential elements in cost behavior. This is what you call variable and fixed cost. You see in this graph, this is the break-even graph. So you can see this vertical line. It is the revenue or cost, revenue and cost, while this horizontal is the units. Now, a variable cost for simple definition is a cost that varies as the number of sales increases, whereas the fixed cost doesn't vary. In other words, it remains constant. Now, if you look at the graph here, the variable cost is the one that is increasing, as you can see the line, okay? That what you call the perpendicular line. So there's the VC or the variable cost. Now, depending on the number of units that's being produced, it also increases. So, for example, if they if they were able to produce 20,000 units, so just look at the graph. That's about they would more or less be able to incur 200,000 total cost. Whereas fixed cost, as you can see here, uh, this one, it remains constant. And so regardless of the number of units produced, it does not increase. So I'm going to show you some examples of variable and fixed cost. But the most important thing for now is that the total variable cost increases as the number of uh, units increases, while the fixed cost, the total fixed cost is constant regardless of the number of units produced. Now let's get some definition here. So since we're talking about leverage represents the use of fixed cost items to magnify the firm's results. In other words, it is just like using a software, now where it can manage to do or to perform multiple tasks that would definitely save, definitely be a labor saving device. So in doing so, they would be able to decrease their cost, which would probably increase their chances for profits. Now, operating leverage indicates the extent of fixed cost, fixed assets, I should say, plant and equipment are utilized by the firm. So like we said a while ago, in para lang sa ano yan sa accounting department, no? So instead of employing like five or maybe even more accounting staff, they would rather invest in a software, computers accounting software, which, however, it would cost them. And this cost, of course, as we know, assets, you don't practically expense all the cost of that software. If, for example, the cost of the software is 1 million, you don't expense that in the balance sheet. So you expense that through depreciation. So somehow it would increase their fixed cost through depreciation. So let's proceed with another. So the financial leverage shows how much debt the firm employ in its capital structure. So remember about the debt. There's always the debt is not or liabilities are not entirely bad. There are also good debts or good liabilities. Now, if they can somehow leverage that in order to increase their output. So by increasing leverage, the firm increases its profit potential, but it also risk of failure. So there's no guarantee, no? So there's a saying that the higher the risk, the higher the investment, the higher the risk. So let's look at some of the examples of fixed and variable costs. So we have fixed cost. One of them is lease. Now, remember, even if you don't use the factory or you don't operate, let's say, for example, you have a store in a mall, like during the pandemic, you would still incur rent from that, no? So it's fixed 30,000. You may be able to avoid, people coming to work. There's no work, no pay, but you cannot entirely avoid the lease or some of the fixed costs, including depreciation, executive salary. Regardless of whether they go to work or not, some executives would still have um, their salary intact, property taxes as well. Variable cost in the meantime, this includes raw materials. Okay, since we know that some of the raw materials, depending on the where they get their materials from what supplier, it it basically increases, or you know in in some instance it may decrease, but it's not a fixed cost, no. No, it's normally increases in an economy that is inflationary. And of course, factory labor, sales commission. Of course, this depends on the volume of sales. It will also increase. Also, labor. Some are getting minimum wage. Some are higher than minimum wage. Now, there are semi-variable, of course. Like utilities, like the water bill or the Meralco bill. You would notice that you would still pay for a certain amount or sum, no? Even if you don't incur that, no? Even if you go on a vacation for 1 month, you would still get a an electric bill because of that, because it has a fixed component as well as variable component inside it. Here, the number of the sales increases. The total revenue line is determined by multiplying the price, which is 2 times the number of the volume, while the break even is at 50,000 units. So we can use this thing here. Okay, this is the formula for break even is fixed cost over contribution margin. So the fixed cost being 60,000, as we saw a while ago, this is divided by 2, which is the selling price less the variable cost. So in other words, contribution margin uh, is obtained by deducting sales from the variable cost, and then you will get the contribution margin. So that would be 60,000 divided by 1.20. That's 50,000 here. So as we can see here, if there is no units sold, we can see that the variable cost also, you won't incur anything, because it's a simple way of saying no work, no pay. But the fixed cost is still remains the same regardless if you work or not. And the total cost as well, and the total revenue, there's no revenue, so there is a loss there. Now, if the company is able to produce and sell 20,000 units, so there's the variable cost of 16,000. So just simply multiply this by 0.8. Yes, 0.8. So 20,000 times 0.8, that would be 16,000. But the fixed costs still remain the same. That's 60,000. And you would see that the total cost is 70,000. That's 16,000 times 60,000, plus 60,000 equals 76,000. And the total revenue is 40,000. That's 20,000 times two, selling two pesos per $2 for selling price. No, okay. There's a typo error there. It's not actually in peso. It's in dollars. So $2 times is 20,000 units. So that's 40,000 US dollars. And so there is still a loss of 36,000, but the loss has decreased by 24,000, as you can see here. 76,000 total cost minus the total revenue of 40,000, that will be negative 36,000. Now, as the units increases by intervals of 20,000, you can say that the variable cost also increases by 0.80 per unit. So if it's 40,000, that's 40,000 times 0.80, that will be 32,000. And the fixed cost would be still 60,000, so that would be 92,000. And the revenue would be 80,000. That's 40,000 times two selling price, $2 selling price. But you could see here that the operating loss has greatly decreased by 24,000. You can see that. So at 50,000, it has achieved its break-even point. So you see, so total variable cost is at 40,000. That's 0.8 times 50,000. And your fixed cost is still 60,000 regardless of the number of units sold. And the total cost would be 100,000. That's 60 plus 40 is 100,000. And the total revenue, that's 50,000 times $2. That's easy to see. So that would be 100,000. So there would be, so 100,000 less 100,000 is zero. So in other words, it suffices to say that total revenue break-even point is when total revenues and total cost is equal. But at 60,000, so the more they produce, the more the chances they're earning. So as you can see here, since they have already overcome the variable cost, so at 60,000, so they would have a 48,000 variable cost. Fixed cost is still 60,000. So somehow, even though their fixed cost is high, once they have achieved the break-even point, for every unit they sell above break-even, it's already a profit. So you can see here, at 108,000, that the total cost is 48,000 times plus 60,000, and then your total revenue is 120,000. That's 60,000 units times total revenue. So 120,000. So that would be 12,000. So 120 less 108. So that's $12,000. And at 80,000, you can see that they have really achieved. So you can see here that the operating income grows by 24,000, assuming there would be a 20,000 increase in the units sold for every output here. So at 100,000, so that's from 36,000, it grew to 60,000. Now, what can you say about this? Now, what can you say about this? So makikita natin dito na habang dumadami yung ano 'no, yung naibebenta 'no, gano'n din yung interval nung increases dun sa operating income. So, yun nga lang medyo mataas yung kanyang break even kasi nag-invest sila sa ano, sa fixed cost 'no, ika nga, 'no? So mataas yung fixed cost nila 'no, yung fixed cost, when I say fixed cost 'no, maaaring nag-invest sila sa isang software 'no, and instead of relying on labor 'no. Now, meron namang iba mga conservative yung approach 'no. So these are things na medyo akala nila sa umpisa they would think na nakakatipid sila, but in reality they're not 'no. And fear of not reaching 50,000 break-even point might discourage some companies from heavy utilization of fixed assets. So they would rather have yung labor, no, the good old labor. No, no, no. There's nothing wrong about that, no. But the thing is, no, that is not strategic, no. Especially, let's say for example, sa isang company, no. So meron kang operation doon, meron kang accounting department doon. Now, all you have there is yung mga redundant naman yung job nila, no? Siguro mga 10 sila doon, no? And you're giving them at least siguro minimum wage, no? Karamihan doon mga staff, no? But they're not really contributing, no? They're, doing those reports, but it's more routinary, no? And you don't know whether it's accurate or not, no? So you try to invest in a software that would cost you about 1 million, no? So kinukumpara mo yun, 1 million, tapos magkano yung pinapasahod mo dun sa siguro sa mga walong ano doon, at least yung mga staff doon, no? Kasi malaki yung company eh, no? Siguro mga bibigay ka ng mga 18 to 20,000, no? I mean, how much is that, no? 20,000 times 8, that would be, well, it's to do the math, no? So, medyo, ano nga, no? Sabihin, sa umpisa nakakatipid sila, pero sa totoo lang, no? Mas malaki yung nagagastos nila, no? Kasi in the long run, no? Yung bawi niyan, eh, mas, when you place a software there, mas makakatipid, no? Sa long run. Now, let's look at this, no? Etong ano na to, no? So, eto, no, they decided to invest in people. So what happened was that yung ano nila, yung variable cost nila increased, no? From 0.8 to 1.60. So yung ano nila, yung contribution na margin nila is 40.40 na lang. Pero yung fixed cost nila is only 12, no? That is just an assumption here, no? So 30,000 units, break even na sila. So kasi yung iba, no, they think na pagka masyado mataas yung break even, no? They think na that would be not beneficial to the company, no? But the thing is, no, if you have yung leverage na yon, you would be able to overcome that break even easily and gain more profit as you go along. So break even graph of the fixed cost that was reduced to 12,000. No, so at 0 units sold, there won't be any variable cost, but there would be a $12,000 fixed cost. And of course, there would be no revenue because there's no operations. There's nothing produced. So there would be still a loss of $12,000. So that could be well, caused by the rent, or and an old machine with a very low depreciation, if you could say that. And that's why they have a lower cost from 60,000. Imagine, from $60,000 to 12,000, no? So malaki. malaki-laki yung ano, yung natipid nila sa hindi pagbili ng machine na yon, no? Or pag-invest ng machine na yon. Because some companies would think that investing in a machine would just cost them, no? They would only look on the short term, no? And now let's take a look at the other volume, no? So let's assume that there's a 20,000 interval for both the leveraged one and the this one, which is not leveraged. So you can see that the unit sold was 20,000 and the variable cost is 32,000. That's 1 point, let me see that again, 1.60 times 20,000 units sold. So that's 32,000 variable cost, and the fixed cost is fixed at 12,000. So the total cost, that's 32,000 plus 12,000 fixed cost, that's 44,000. And then you have a revenue of 40,000, that's 20,000 times $2. You know, even if the variable cost increase, the variable cost per unit increased, the selling price remains the same, in order to be competitive. So you still incur a loss of $4,000. Now, it's not as high as the other one, the leverage company, where the losses are, well, uh, more more higher than the less leveraged one. When I say leverage, this is where the company invests in a machine or a software, and the less leverage, they invest more on the labor. Now at $30,000, they have already achieved the break-even point. As you can see here, the total variable cost, that's 30,000 units sold times 1.6, and that would be $48,000, while the fixed cost is, well, 12,000. So that would be a total cost of 60,000, while their sales is $60,000. Now sales and the total cost are the same, so that's why they have break even at zero. So at 40,000, you can see that they have already earned for $4,000. And for 60,000, another 20,000 intervals from 40,000, there would be a 12,000 operating income. So you can see here, the other one, no, yung leverage company, meron siyang 24,000 yung ano, yung hakbang niya, no? Ika nga yung net advantage niya from the previous, no? Dito parang mas maliit, no? It's only from 4,000 to 12,000. That's about 8,000. So ganun rin pagka another increase in units sold for 80,000, you can see that the operating income is increased by 8,000. So mas maliit, no? Ano yung ano rito, no? What's the reason here? Now, at 100,000, you can see that their operating income is only 28,000. So the point here is that the company may be able to reach its break-even point faster than a leverage one. However, for every unit they sold after break-even, their variable cost is still increasing. Nagbabayad sila ng ano, ng labor cost, no? That's why they're so ano, kumbaga yung bang their profits are not that not that increasing as much as they would want to, compared to the leverage one, which has exponential profits. Now, because once they have already over overcome the break even, so yung fixed nakapako na lang yan, no? So for every unit they sell, no, they would incur lesser variable costs. Now, financial leverage is not about borrowing money. It's about making high stakes bet on your fixed cost structure. Choose carefully. Do you want safety pero wala masyadong profits? Or do you want dominance? You invest in a an equipment or a machine that would double your output, and it would also improve the quality of your products. No? Next week we are solving the most technical challenge facing strategies today. We dive into blockchain accounting, the unflinching ledger that kills the corruption predator. Subscribe now.